Mhm. Assalamualaikum and good day to everyone. So before I start, let me introduce myself first. I am John Pauline R. Marindoki and our group chose the Del Monte Food Incorporation. So our video will contain the vertical analysis, horizontal analysis, liquidity ratio, activity ratio, solvency ratio, profitability ratio, short overall interpretation based on financial statement analysis. But I will tackle only the vertical analysis. So let me give you a brief introduction of our chosen corporation, which is Del Monte Incorporation. So Del Monte Philippines Incorporation is a leading producer, distributor, and marketer of premium brand quality, healthy food and beverage products. It has been in operation in the Philippines for 98 years and is a market leader in the packaged pineapple and mixed fruit, ready-to-drink juices, tomato sauce, and spaghetti sauce categories. So vertical analysis is a financial statement analysis technique that expresses each line item as a percentage of a base figure. It is also known as a common size analysis. So balance sheet formula is balance sheet divided by total assets or liabilities times 100. So the balance sheet for the Del Monte. So the balance sheet shows that the company's non-current assets account for 52.5% of total assets in 2024, similar to 51.69 in 2023. This means more than half of the company's resources are tied to long-term investments. Current make up 47.94% in 2024, showing a stable amount of short-term resources to support operations. On the other side, liabilities take up large portion of total assets. Non-current liabilities represent 50.12% in 2024, slightly lower than 52.75% in 2023, which means the company reduced its long-term debt slightly. Current liabilities increased to 16.55% in 2024 from 12.1% in 2023, showing more than short-term obligations. Meanwhile, equity decreased to 33.33% in 2024 compared to the 34% in 2023, meaning the owner's share to the company's resources slightly dropped. Overall, the company relies heavily on liabilities, especially long-term debt, to fund its assets, while equity has slightly decreased. The balance between assets, liabilities, and equity reflects how the company manages its finances over time. So let's go to the income statement. So for the formula of the income statement, it is income statement divided by the total assets times 100 to get the percentage. So the vertical analysis of the income statement shows how each line item compares to a total net sales, which is treated as 100% for each year. So it is 100% from in the 3 consecutive years. So the cost of sales has been decreasing from 85.90% in 2024 to 76.90% in 2023 and 76.7% in 2022. This is a good sign because it means that the company is spending less on producing or buying the products they sell. As a result, the gross profit improved, increasing from 14.1% in 2024 to 23.10% in 2023 and 23.93% in 2022. However, operating remains significant, taking up around 7% to 11% of sales. Despite these improvements, the company experienced a net loss in 2024 and in 2023, showing the struggle to control total expenses in those years. In 2022, the company recorded a net income of 3.47%, which is a sign of improved profitability that year. Overall, the company faced challenges managing costs and expenses in 2024 and 2023, leading to losses, but they performed better in 2022 when they achieved a net profit. So, that's all for the vertical analysis of the Del Monte, and it's my part. Thank you so much for your attention.
Good morning, good afternoon, or good evening, ma'am. I am Princess Morgan Sabas, and I am one of the members from the Group 5. My part, or this video, I will present to you the horizontal analysis of the Monte Food Corporation Holdings. But first, what is horizontal analysis? Horizontal analysis compares financial data over time to identify trends and assess the company's performance. These analysis provides insights into areas that require improvement and those that are performing well. So I have put a sample to get the horizontal analysis on financial data. Those are just selected items, a few selected items from the financial position of the Monte Food Holdings. Nandyan yung year 2024, the current year, and the previous year. Also yung changes, the numbers are from US dollars siya. Also the percentage change. Right, so we'll be discussing the changes and key financial position in each items. No, I am sorry if I am looking down kasi sa laptop ko pa for the data. Right, so I will tell you the interpretation of this analysis of financial position. First item, non-current assets. No, meron tayong 2023 and 2024 data kung saan from the previous year ang ating non-current assets last year 1,208,588. Tapos meron naman tayo ngayong year, 1,219,310. So ang gagawin po natin ay ima-minus lang po natin siya. Diyan po natin makikita yung result kung ilan yung na-change, kung nag-increase ba siya or nag-decrease. After nung kukunin mo lang yung percentage change, no? So for this item, no, nung di-minus natin yung previous year to this year, nakakuha tayo ng 10,722 and it has increase po siya. As we can see, we got 0.89%, no? It has slightly increased due to retained investments in property, plant, and equipment kasi yun nga ng current assets siya. Ito yung hindi na move na assets. The current assets, as you can see, for the previous year, 1,129,000. It has decreased for the 2024. 1,123,000. Ang kanyang na-decrease na change ay 6,575. For the percentage, we got 0.58%. Minor decrease driven by a reduction in cash and receivables. For total equity, last year, 816,841. Bumaba nga lang siya for this year, 710,576. So, ang naging change niya ay for about 106,265. That's about 13.1 percentage. Declined significantly due to a net loss which increased the deficit balance. Liabilities naman, as you can see, nag-increase siya from the previous year to our current year from 1,500,000. Nag-increase siya for about 110,412. Ang percentage change has increased mainly due to higher intercompany payables and loans, reflecting greater dependence on external or related party financing. Yun naman ang kukunin natin or i-discuss ko sa inyong interpretation of the horizontal analysis of income statement. First, on the net sales, we had 1,733,102 last year, last 2023. It increased 1,737,342. Sales have barely grown, showing stagnation and revenue generating capacity kasi nag-increase lang siya ng 0.24%. For the cost sales naman, 11.97%, a sharp increase likely due to rising material production or operational costs. This has severely impacted profitability. Third, profit. Gross profit dropped 38.79%. It dropped significantly, indicating that the company isn't managing its production costs effectively. Operating income, 117.70% ang na-change, so from profit to loss due to rising operating expenses such as selling and administrative costs. Net income loss, it has dramatically increased in loss caused by higher finance expenses, reflecting potential cash flow issues or high borrowing because as you can see, negative 3,933.20% ang naging change niya. From 2023, i-minus mo siya sa 2024, 115,700 ang nabawas. The analysis, it is clear that rising costs and increasing liabilities are the main challenges for Del Monte. Despite stable sales, profitability is declining due to operational inefficiencies and high borrowing costs. Addressing these areas is crucial for improving the company's financial position. We also have put recommendations or suggestions that suggest actionable strategies to improve the company's performance. First, cost control. Del Monte should streamline its operations to reduce production and distribution costs. This could involve renegotiating supplier contracts or optimizing production processes. Second one, revenue growth strategies. The company can explore new markets or launch innovative products to boost sales. Investing in targeted marketing campaigns might also help increase market share. Third and last suggestion strategy will be debt management. Reducing high interest loans should be priority. Improving cash flow and restructuring debt can help alleviate financial strain. In conclusion, the horizontal analysis reveals that while Del Monte Foods maintains stable sales, the company faces significant challenges due to rising costs, increasing liabilities, and declining profitability. Addressing these issues with cost control measures, revenue growth strategies, and better debt management can help the company stabilize and improve its financial performance. I think that is all for my part and discussing. I hope that I have discussed horizontal analysis properly. Thank you. That's all. Bye po, ma'am.
Welcome to Del Monte's liquidity analysis. So Del Monte is a global food dealer, requires effective liquidity management. So here's the net working capital calculations. Net working capital is equals to current asset minus current liabilities. In 2024, the current assets is 1,123,146 pesos minus the current liabilities, which is 387,733 pesos, equals to 735,413 pesos. And in previous year, the current assets is 1,129,721 pesos minus 287,911 pesos and equals to 841,810 pesos. For the current ratio calculation, current ratio equals the current assets divide current liabilities. In 2024, the current assets is 1,123,146. Divide the current liabilities, which is 387,733, equals to 2.90%. And in 2023 calculation, the current assets are 1,129,721 divided by 287,911 and equals to 3.92%. For the quick ratio calculation, quick ratio equals the quick assets divided by the current liabilities. So ito yung quick assets natin, the inventories and the prepaid expenses. In 2024, the total quick assets is 1,123,146 pesos minus the current liabilities, which is 387,733 pesos. It equals to 735,413 pesos. While in 2023 calculation, the total quick assets is 1,129,721 pesos minus the current liabilities 287,911 pesos and equals to 841,810 pesos. Del Monte's liquidity ratios indicate that there are decrease in net working capital ratio from 841,810 noong 2023 is naging 735,413 na lang siya noong 2024. And there's also a decline in current ratio from 3.92% in 2023 is naging 2.90% na lang siya noong 2024. The quick ratio also weakened from 0.51% noong 2023 is naging 0.33% na lang siya noong 2024. Monte's liquidity position has slightly weakened. Investors and stakeholders should monitor these ratios. So thank you for watching. Stay informed about Del Monte's financial performance.
Hi everyone, good day. The financial statement of Del Monte using the activity ratio with their formula. So we have a balance sheet and income statement in a year of 2023 to 2024. So before we start, let me introduce myself. Hi, I am Marilyn Hajisata and let's begin. The Del Monte's inventory turnover ratio improved slightly in 2024 is 1.57 compared to 2023 is 1.40, indicating that the company was selling its inventory slightly faster, suggesting improved efficiency in managing inventory. However, the age of inventory increased in 2024 is 229 days compared to 2023 is 257 days, suggesting that Del Monte was holding on to its inventory for a longer period. The Del Monte's receivable turnover ratio remained relatively stable in both years. It is 13.07 in 2024 and 13.04 in 2023, indicating consistent collection practices. The age of receivable also remained stable in 28 days in both years, suggesting that the company is collecting its receivables in a timely manner. The Del Monte's payable turnover ratio decreased in 2023 is 7.84 compared to 2024 is 8.77 indicating that the company was taking longer to pay its supplier in 2023, suggesting a slight improvement in payment efficiency. But the age of payable also increased in 2023, which is 46 days compared to 2024 is 41 days, further supporting the trend of slower payments. The Del Monte's assets turnover ratio remained consistent in both years, which is 0.74, suggesting a stable level of asset utilization efficiency. Similarly, the fixed asset turnover ratio remained consistent at 1.43 in both years, indicating consistent efficiency in using fixed assets to generate revenue. The Del Monte's normal operating cycle decrease in 2024 has 257 days compared to 2023 has 285 days, suggesting that the company was converting its inventory into receivable more quickly. The cash conversion cycle also improved and 2024 has 216 days compared to 2023 has 239 days, indicating that Del Monte was converting its investment into cash faster. Anyway, the Del Monte's financial performance in 2024 showed some improvement in working capital, which are the normal operating cycle in the cash conversion cycle, particularly in inventory and receivable. However, the increase in the age of inventory in the longer payment cycle to supplier in 2023 suggests areas for ongoing attention and optimization.
Assalamualaikum and good day to each and every one of us, especially to our dear viewers and to our dear professor, Professor Naira Raihan M. Macaumbos. This is Steve Francis P. Lablada speaking, the leader of Group 5, and as you requested, ma'am, we'll be going to choose a corporation and discuss their financial statement analysis. But in this video presentation, we will be focusing on profitability and solvency ratios. So without further ado, let's begin. The corporation that our group chose is the Del Monte Food Corporation, and it was founded in 1886. It is a U.S. company recognized for its canned fruits, vegetables, and beverages. In 2014 naman, it was acquired by KKR, separating its fresh produce division into Fresh Del Monte Produce. This presentation also will analyze how Del Monte managed its finances, specifically focusing on its profitability and solvency. So first, let's define the terms. Profitability ratios measure a company's ability to generate earnings relative to its revenue, assets, or equity. Meanwhile, the solvency ratio measures a company's ability to meet its long-term obligations. So let's move on to the profitability ratio analysis for the fiscal year 2023-2024 of the Del Monte Food Corporation with our given financial statement. Profitability ratios pala measures how well a company generates profit from its revenue, assets, or equity, as I said earlier. But the key metrics include the net profit margin, the gross profit margin, operating profit margin, return on sales, assets, and equity. So those are our key metrics in solving the profitability ratios. But in this presentation, we'll be just cutting the edge, or we'll be just summarizing it so that it won't take too long. So, yan na nga yung sinabi ko kanina, dyan sila operating profit margin, gross profit margin, net profit margin, return on sales, equity, and assets. So, in 2023, the Del Monte had a net profit margin of 23.1%. This result show a decline in profitability due to either increased loss or increased cost rather, or lower revenues. Meanwhile, in 2024 naman, this dropped to 14.1%. The company also shifted from an operating profit of 153.5 million in 2023 to an operating loss of 27 million in 2024. as I projected in my screen, makikita naman natin dyan sa kanilang income statement. So this result show a decline in profitability due to either increased costs or lower revenues, as I said earlier. So moving on to our solvency ratio analysis naman, solvency ratios help assess a company's ability to meet long-term obligations. Important metrics include the debt ratio, equity ratio, and debt to equity ratio. Yan sila. At ito yung balance sheet or statement of financial position ng Del Monte Food Corporation. So moving on for my interpretation of financial analysis, or specifically insolvency ratio of the Del Monte Food Corporation for the fiscal year 2023, the debt ratio was 69.6%, meaning a large portion of their assets was financed by debt, which is very bad. By 2024 naman, this improves slightly to 65.7%. Similarly, the equity ratio increased from 30.33% to 34.93%, showing a shift toward more equity financing. So these numbers indicate a slight improvement in financial stability, although the company still relies heavily on debt. Makikita naman natin yung kanyang pagbabago sa 2024. So overall, the financial statement analysis shows that Del Monte Food experienced a drop in profitability from 2023 to 2024, likely due to operational challenges. However, the company improved its solvency metrics slightly, suggesting efforts to manage debt more effectively. To strengthen its performance naman, I think it's better to what we call this. It's better that Del Monte implement this recommendation of mine as a reporter and as your student also, Ma'am Narina, that they should focus on reducing operating costs and exploring new high margin products and balancing its financing methods. So in conclusion of my report, the Del Monte Foods has shown resilience despite challenges but has room for improvement in profitability and debt financing. Thank you for your attention and I'll be happy to answer any questions, but sad to say, this is just a pre-recorded video presentation. So that will be the end of my report for my topic, which is all about solvency and profitability ratios.
So this is the short interpretation of the Del Monte's financial statement analysis. So Del Monte Foods financial statements show a company with stable revenue but struggling profitability. Vertical and horizontal analysis revealed that rising costs, including cost of sales and operating expenses, are shrinking margins. Liquidity is tight, with current assets barely covering liabilities, and activity ratio suggests slower inventory turnover. The company's solvency is concerning given its high reliance on debt, which significantly outweighs the equity. Profitability ratios highlight net losses due to the operational inefficiencies and high finance costs. Overall, while the company maintains steady sales, it must address cost management, improve efficiency, and reduce its debt reliance to achieve financial stability and long-term growth. So that's all with together with the group 5. Again, I am Jan Pauline R. Marindoque. Thank you so much.